Welcome to another portfolio update here on The Last Investor. My name is Dan, and in today's video I'll give you a very brief update on my portfolio to date, and then I'm going to dive right into the topic of today, which is to discuss the do's and the don'ts when investing in the stock market. I'll be giving you 5 do's and 5 don'ts, which I think are very important things that I take into account when I'm investing in the stock market. And I think this video will be particularly useful to new investors who are coming into this market, and just to ensure that they are able to invest in the right way, because I knew that it was very important for me when I started off in the market to understand what sort of things I should be doing and what sort of things I should be avoiding. And I'm sure if everyone knew that at the beginning of their investment journey, that would save them a lot of time, a lot of hassle, and a lot of headache, that's for sure, because the market is a very, very punishing place if you approach it the wrong way. So enough of that, straight to the portfolio update. So starting off with CRISPR Therapeutics, so far this week, in the last 7 days, it's up 3.5%. My total holdings now stands at £1,373. That's 71.98% up. I'm up £574. So not bad. Still holding in there with CRISPR Therapeutics. Invitae in the last 7 days up 5.21%. So my total holdings now £1,137. 13% up overall. Now up in gains of £132. Rio Tinto in the last 7 days has gone down slightly, 1.1% down, but overall I'm up £927, 13% up overall, £111 gain. And then Editas in the last 7 days, it's up 0.86%, overall it's up 12%. £99 gain, total current value £915. Illumina is still down, but up this week very slightly, marginally, 0.81% up, but overall still down 10.82%, down £106. Total current value is £878. And then we have Intelia in the last 7 days up 2.74%. Total gain overall is 8.51%, £68. Current value £874. So not bad, still good overall. Sentiment has just been brilliant and continues to do so. Last 7 days up 5.92%. Overall, I'm up 91.8%, 91.88%, which is £411 up. On my current investment value is £859. Then Aviva in the last 7 days is down 4.28%. It's dropped again, now down 11% overall, down £100. Current value £770. And then also have 3i, which in the last 7 days is down 1%, and overall is down 14%. Current value £739. Trig Renewable Infrastructure Group is in the last 7 days up 1.34%, overall up 6.63%. Current value £679. And finally I have Carnival Corp, which is up 1.51% in the last 7 days, and overall my investment is still down 51%. Current value £582. I think the cruising industry in Europe in particular has started to open up slightly. I think one of the cruise companies, MSCI, has managed to successfully get through a cruise, but that was literally limited to just the Italian citizens and Italian nationals, and it's a cruise around the Italian coast itself. So it's still good news, still positive news, but it's far from the full reopening of the cruise industry. I think the US in particular are still closed. Majority of cruises aren't taking place in the US at the moment, so that is still a major issue there. But for now, it's a bit of a positive that the cruising industry seems to be opening up slightly. So that's the update for most of my stocks, which are over £500. The rest of my stocks are below £500. I'm not going to bore you with those. Now, moving on to the topic for the video, I want to talk about the do's and don'ts of the stock market. And this really is a timely reminder for us, especially now that we've got the S&P 500 and the stock market on the whole literally just going up non-stop. And for new investors, I think the assumption is that this is always going to be a continued trend. But it's important to really understand that we're probably in a stage where the stock market is pretty much quite overvalued at this point in time, and there's always a risk that you invest in the wrong type of stock or the wrong sector in this particular period and you'd end up getting burned, especially if the fundamentals do not support it, or the stock market conditions or the conditions in the economy do not support that particular valuation. So it's really important to understand these things and understand what we should be doing and what we shouldn't be doing when looking to invest in the stock market. So without any further ado, I'm going to jump right into it. So number one, do research the stock before you buy it. If you buy a stock without researching it, then you seriously need to ask yourself, what have you based that decision to buy on? It's clearly not on the basis of fundamentals. You would only find that out by researching the company. And then buying a stock without researching is not investing, it's really speculating. It's as good as taking your money to the casino and hoping that you will roll a 7 on the dice. It's pure gambling. And number two, do make sure you know what type of company you're buying and why you are investing in the company. This is very important because you need to know what the long-term returns you're going to achieve from the stock would be and whether the characteristics of that company support that goal. You need to understand this, otherwise you will not have the right temperaments to hold the stock long term, especially if it's not doing as you're expecting it to do. I mean, there are different types of companies. For example, a fast grower or a growth stock. What you really should be looking out for in those types of companies is, has it created a new product or service category where none had existed before, similar to how the iPad was created by Apple at the very beginning, creating a completely new market, and then that generated a whole load of revenue for it going forward? Or is there a new technology that the company has developed which is going to disrupt the existing market, as in the case of the iPhone, for example, which disrupted mobile devices that existed prior to the iPhone being released, and then brought in a new advent of touch screens, and that intuitive touchscreen movement which we now have and we now enjoy pretty much today. So you need to understand what it is and why it is that you invest in a particular company. What are they bringing to the market that's new? If they're bringing something really new, which is really radical, then of course you could be looking at that company as a fast grower or growth stock. But if they aren't doing any of those, if you don't understand what it is that they're doing, then you're best to stay away from it because you don't understand it. But if you do, then obviously that's how you value it. There are other types of companies to look out for. For example, if you're looking for something that's going to pay your regular income through dividends and you want it to make sure it obviously maintains its value, those companies are usually referred to as stalwarts companies. So you need to understand what it is that makes a company maintain its share. Usually companies like that would have a large moat or large competitive advantage which is very difficult for them to lose. An example would be McDonald's. McDonald's is an established brand, it's been around for decades, and most children they would always want to go to McDonald's, so they have that established moat, which is going to be very difficult for other companies to break into and take over. Similar, another example of a stalwart would be Coca-Cola. Again, a very strong established brand, very difficult for other companies to break into them. So if you're looking for a company who's just going to pay you a very steady dividend income, but at the same time it's not going to lose its value over time, because it's very rare or very unlikely that another company is going to come over and basically take over and disrupt its business model. It doesn't mean that it never happened, it just means that the chances of that happening are probably less likely, but it's something you should always keep an eye on for. So do number 3, do buy for the purpose of holding long term. If you see yourself holding on to a stock for over at least a year and preferably much longer, then buy it. So here there is simply no point in buying a stock which you only plan to hold for a few months. It is very unlikely that something fundamental will change within such a short period of time. I mean, most companies will have a runway period where they'll achieve their expected goals, and most will be over a number of years, not months. So an example that I always give is, if you had invested $100 in Apple a year ago, you would have more than doubled your money today by up to $243. So simply by holding for a full year, you've pretty much doubled your money. But if you'd actually held that £100 for a period of 5 years, then it would have gone up by 5 times, which should be $500. And if you invested over a period of 10 years, then that £100 would now be worth £1,410, which is 14 times in value. And if you invested at the very beginning, when Apple IPO'd or it went public and was selling its shares on the stock market, which was around 1980, over that 40-year period, that £100 would now be worth a stunning £127,617 today. That is an incredible 127,000% increase in value. So that really goes to show the power of remaining invested for the long term. Of course, it's got to be the right company. Then do number 4. Do buy companies that you believe will be around for years to come and will grow their market share and innovate. So as given in the example above, you need to look at what the company is doing to stay ahead of the competition. The company must have a competitive edge, a moat, or a monopoly. If it doesn't have this, then it is vulnerable to having its market share taken over in the long run, and therefore it will inevitably lose value. And if you can't identify what sets a company aside from the rest, then the best thing to do is simply avoid it, because you don't understand the business enough to have faith in it in order to hold it for the long term. And then a final do is do hold a diversified portfolio and invest only in your very best picks. If you don't know how to pick individual stocks, then to be honest, you're better off just buying and holding an index fund instead, sort of like an ETF, or in the S&P 500 Vanguard ETF, something like that, which is probably much more safer than trying to pick individual stocks. And the reality is that we're all human, and inevitably we don't know everything, so it is always best to be diversified into different sectors or even uncorrelated asset classes. So keep that in mind. Then on to the 5 don'ts. So the first of the 5 don'ts is don't buy a stock if you don't know it. If you don't understand it, don't buy it. So you must always stick to your circle of competence. If you don't understand the business behind the company, then you will very likely lose money, because when it goes down in value, you will not understand what those drivers behind it are, and you won't know whether to stay invested or not. You will most likely make a poor decision because you never understood the business in the first place. So that really is quite straightforward. You can't be buying stuff you don't know. because when things happen to it that you're not expecting, you didn't even know you didn't know why you were buying it in the first place, and so you're likely to make a poor decision when it comes to the difficult times. Number 2, don't buy it because other people are buying it. This is called FOMO, which is also referred to as fear of missing out. A lot of people rush into a stock because other people are buying it. I mean, Tesla is a classic example at this point in time. And to be honest, that has never been a good reason to buy, and will always guarantee to lose you money. I'm not saying that Tesla is going to drop in value, but what I'm simply saying is that if you don't understand why it is you're getting into the stock in the first place, then there's a huge risk that you would not know why you want to stay invested in it. So don't simply follow other people just because they're doing something, because that is always a recipe for disaster. And one of the other classic examples as to why not to follow people is even the top people in the business don't always get it right. According to research, 89% of fund managers fail to beat the S&P 500 index. In other words, 90% of professional money managers who receive fees for their services were all outperformed by the S&P 500 index, so they were not able to beat the index itself. So you'd have been better off simply just putting your money in something like the Vanguard S&P 500 index ETF, and that would have paid you far better than if you'd put your money in a fund manager and basically paid them to invest it for you. So if they can't do better than the index, then really what good is following any other person who might just be an amateur, who might not know much about the stock market in any event? So that's really a lesson as to why not to simply just follow others. And the reality is, if you don't know what you're doing, then simply stick to buying an index fund like an ETF. That is always going to be the best option for you. And then number 3 don't buy high and sell low. This might sound pretty obvious, and believe you me, it's easier said than done. It might sound really silly to say, well, why would I buy high and then sell low? But the reality is, most people buy when there's euphoria. When there's euphoria, people tend to there's a high emotion to want to buy when there's euphoria. Look at the Tesla stock again. I come back to the Tesla stock, not simply because I hate Tesla or anything. I mean, I invest in Tesla myself, but the reason why I'm raising this is because it just shows how much pull, how much gravity there is to want to invest in something simply because there's a lot of euphoria around it, and obviously the price has gone up, and you're buying. If you buy at this stage, you're buying high, and if things go wrong for whatever reason and there is a huge drop in the market, a lot of people get scared and there'll be fear in the market, and a lot of people tend to sell when there's fear in the market. That is the fundamental issue with buying high and selling low. It is a real driver, it's a real thing, and has real power and real force. And people who tend to succumb to these are people who don't really understand what they were doing in the first place. So always be wary about buying high and selling low. And how would you know that? The only way you're going to know that is by understanding the fundamentals behind the company, to understand what the true value of that company is, and to understand where you're expecting to get to in the future with it in terms of that value. If you don't know those things, you're pretty much making a shot in the dark, and you're very, very likely to buy high and sell low. Number 4 is don't trade frequently. Buying and selling stocks too frequently is a sure way to lose a lot of money in trading fees. Even if it's a no commission platform like, for example, Freetrade, Robinhood, most of these platforms make money through a system called payment for order flows. So what it is basically is that they collect all the orders that you put on the platform, and they send it off to money makers. And those money makers are the ones who then sell the stocks to these platforms. Now, the money makers, they obviously are incentivized to bid for your sale orders. So they will usually offer a very good commission to the platforms so that they can get those orders. But when they receive those orders, they have no incentive whatsoever to sell at market price. They would usually have a markup, which inevitably would include the commission that they've paid to these platforms for buying their order flows for buying the order flows that those platforms sell onto them. So you can see where the conflict of interest lies. So when you're buying shares, don't think that you're buying it at market value. The reality is you're probably not. And the reality is that the more you do of this, then the more you're losing value, because you're making too many trades, especially when you're buying and selling. And the premium on both sides would eat into your valuation long term. So knowing this, you should also be cautious about how often you trade, especially when looking at what we talked about being a long-term investor. It's also important when you look into this that there are just too many reasons why you should try and avoid trading frequently. And being a long-term investor, it's absolutely fine. If you buy and hold for a longer term period, you gain more value that way than simply trading in and out of trades. It's never going to be worth your while. And finally, final don't is don't lose money. If you ask Warren Buffett what his rules are for investing, he'll tell you that there are two. The first is don't lose money, and the second is don't forget rule number one. So what does this mean? It means be careful in the stock market and invest very, very carefully. Only make investment decisions that are backed by thorough research, a good understanding of the business, and a long-term goal. If you cannot answer yes to those, then don't invest and don't lose your money. So that's it. Hope you've enjoyed that. I'm hoping that this video you'll find it very pertinent, because really we're at a stage in the market where the stock market is somewhat divorced from the real economy. We know that the economy has been struggling. There are lots of unemployment. Lots of retail businesses have struggled. There's been lots of foreclosures and lots of companies which have gone bankrupt. So there are lots of traps out there in the market at the moment, and therefore quite a few stocks will be overvalued. And so it's very important that you remain careful and follow these rules as best as you can. Hope you've enjoyed this video, and if you think that other people might find this useful, then please share this video with them, and also please like, comment and subscribe. Peace.